not dead out there, Peter. What does this signal to you?
Well, look, what I think we're seeing is there are some big forces, sort of underlying tectonic plates, that are pushing for more M&A. So the energy transition, returns to scale from ongoing technological innovation, a revolution in biotech, the decoupling or partial decoupling of the global economy with China, and the rise of private capital, which has really been a dominant force over the past 5 or 10 years. So you have those kind of drivers, and then on the countervailing forces, financing conditions, antitrust, and generalized uncertainty. And so it's the interplay between, again, the underlying tectonic plate forces that are pushing forward and some of the constraints that are holding things back. And, you know, it will to and fro as the positive and negative forces interact with one another.
Well, on the financing front, which is why a lot of the capital markets activity slowed down so much this year, what are you telling clients? Is that going to turn next year?
There's been a little bit of a thawing, or the early signs of thawing. I mean, especially in investment grade debt and credit. But we're not going to see a significant shift until there's a shift in monetary policy, which you and I have discussed before. That will be the big moment. And, you know, I think the question for many non-investment grade companies will be this interplay between that phenomenon, the sort of central bank pivot, and the maturity wall of a lot of debt maturing in 2025, which is where a lot of credit market analysts are looking.
Just on a note on the Coupa deal, because it was a pandemic winner, and we're wondering about so many of these valuations of these companies that have just been brutally taken down this year. Coupa was down 61% so far this year. Do you expect more private equity buying up software or other COVID winning type stocks? Is that an area of focus for you?
Well, I'm obviously not going to comment on a specific transaction, but I think one of the things that you're seeing also is that the longer that the new equity pricing is in play for, the more likely it is that you're going to get transactions for companies that are realizing, you know, this is partially the new normal. And that makes the transaction more possible. In addition to the financing constraints that you mentioned before, one of the other things that had been holding up M&A, at least in certain situations, is this disconnect where a company thought it was worth 100, then it traded down to 50, and the board of the selling company, you know, wants to hang on in the hope that it will get back to 100.
On the financing
and
side, you said
that changes over time. Yeah. In other words, that changes. Yeah. The more that you're in the new environment, the more likely it is that the seller will be amenable to a transaction.
Got it. So you think the Fed should what? Pause here?
I think the Fed should pause here. Only about a third of what the Fed...
What are you seeing that they are not?
Well, it's not what I'm seeing that they're not. It's a judgment about the relative pros and cons and the risks. Something like 2/3 of the impact of what they've already put into the pipeline has not yet hit the economy. In other words, we've only seen about a third of what they've done to date. So I think it would make sense to pause, wait and see what the impact of what they've already put into play, that pipeline effect, is going to be affecting the economy in a big way in 2023. See what the impact of that is, and also whether the disinflationary process continues. Obviously, we have an important report out tomorrow. There is a little bit of a disconnect that's happening between the price dynamics, where we had an encouraging CPI report last month. We'll have to see what tomorrow looks like, and the wage information, where wage growth remains unabated. But for right now, there's a lot more monetary policy tightening that is in play that they've already done that will be hitting the economy, and I'd rather wait and see what that does, especially because there is plenty of uncertainty coming in 2023 from the debt limit on, and it would be better to pause and wait and see than to go up and then be forced to come down, which I think is a risk for both the Fed and the ECB in 2023. That's not good for their credibility either.